All right, today we're going to crack open the playbook that companies use to go from just a private idea to a stock that you and I can trade. It's a pretty wild journey. Think massive growth, a ton of scrutiny, and of course, some seriously high finance. So let's dive right in. So, you've probably heard about companies having their big moment, debuting on the stock market. But what does that actually mean? How does some company you've maybe never even heard of suddenly just pop up on your trading app? Well, that's the exact journey we're going to follow today. Okay, so the very first step, the big debut party, if you will, is called an initial public offer, or what pretty much everyone calls it, an IPO. This is it. This is the moment a company steps out from behind the curtain and onto the public stage for the very first time. What's so important here is that word unlisted. An IPO is only for a company that hasn't been on the stock market before. It's their one and only first invitation to the public saying, hey, you can buy a piece of our business now. This is that huge fundamental switch from being private to being public. Yeah, going public is definitely not as simple as flipping a switch. It's a super regulated, pretty complex process. First, you've got to assemble your team of experts. And the merchant bankers, they're the real MVPs here, kind of like the directors of the whole show. Then comes this monster document called a prospectus. It has everything about the company for both the regulators and potential investors. And only after all that, after pricing and opening the offer, only then do you get to that final step, listing on an exchange. That's the moment you can actually start trading the shares. All right, so the doors are open for business, but who actually gets invited to the party? Well, it's not a free-for-all. Turns out there's a pretty specific guest list, and the regulator, SEBI, has strict rules about how many shares get set aside for different types of investors. And this breaks it down perfectly. You've got three main groups. First up, retail individual investors, or RIIs. That's probably you, it's me. Then you've got the non-institutional investors, or NIIs. These are folks or companies with a lot more cash to play with. And finally, the heavy hitters, qualified institutional buyers, or QIBs. Here, we're talking about the big institutions like mutual funds and banks, the ones managing massive pools of money. So what's the magic number? What's the line in the sand that separates a regular retail investor from the next category up? It's right here. 2 lakh rupees. If your total application in an IPO is 2 lakh or less, congratulations, you're a retail investor. If you go even 1 rupee over that, you're bumped into the non-institutional category. And check this out. Here's a cool little perk for being in that retail category. To get more everyday people involved, companies can actually offer their shares to retail investors at a small discount. So you might get a slightly better price than the big institutional players. It's a small thing, but hey, it's a nice little advantage. Okay, but an IPO is really just the beginning of the story. I mean, a successful company is always a growing company, right? And growth, well, it almost always needs more money. So, what happens next? How do they raise more cash? Well, there are 2 main paths they can take. The first is called a further public offer, or an FPO. Think of it like a sequel to the IPO. The company's already public, and now it's selling more shares to the general public again. The other path is a rights issue. This one's more of an exclusive, members-only deal. It's an offer made only to existing shareholders, giving them the right to buy more shares and usually at a pretty sweet discount. This brings us to maybe the biggest question of all for any of these offers. How in the world do they decide on the price for a share? Is it just some number they pull out of a hat? No way. It's actually a very deliberate process, and there are 2 main ways they go about it. So the method you're going to see most often today is called a book-building issue. Instead of one price, the company sets a price band, let's say somewhere between 100 and 110 rupees. Then investors, like you, me, and the big institutions, we all place bids saying how many shares we want and what we're willing to pay within that range. The final price gets discovered based on all that demand. The other way is the fixed price issue. Much simpler. The company just picks a single price, and that's it. That's the price for everyone. So the key thing to get about book building is that it's all about price discovery. The company isn't setting the price. It's letting the market set the price. All those bids from thousands of investors come together to show what the real demand is, and that's how they land on the final number. It's a really dynamic way to see what your stock is actually worth in real time. All right, so we've gone through a lot here, right? We've covered the big debut, the guest list, how the price tag gets set. But why does any of this actually matter? Why should you care about this playbook? Well, think of all these terms as your personal decoder ring for the market. When you hear IPO, you don't just see a stock symbol. You see a company's grand entrance. You hear FPO or rights issue, And you know that's the next chapter in their growth story. You know who the RAIs and QIBs are, and you know that the share price isn't just a random number, but the result of a process like book building. Because ultimately, when you understand the journey from an IPO to an FPO, you're not just learning financial jargon. You're actually understanding the entire life cycle of a public company. It's not just about numbers on a screen, it's the story of a business growing up right in front of our eyes. So the next time you see a headline about some blockbuster IPO, you'll have the playbook. You'll know the lingo, you'll get the process, and you'll be able to see the real story behind the stock ticker. The only question left is, whose journey are you going to follow next?